In April 2023, Zomato became EBITDA positive and their share price jumped to 50 rupees. This was a year ago. Now the situation is completely different. The company is profitable, not at the EBITDA level, at the company level. This has sent the share price soaring to 190 rupees, almost 4x in a year. A true multi-bagger. But what is the reason behind this? Is it still a good buy at such high prices? Which business of Zomato is the most promising? Food delivery, Hyperpure or Blinkit? We will answer all these questions, backed by data, and give you our conclusion. Then you decide what you think. Will this company be the next multi-bagger of the coming decade? Zomato. This stock gave an insane listing day gain of 65% on its IPO. But sadly, it was a downward spiral after that. It kept going down to the point where the stock lost about 65% of its value. It was deemed a bad, unprofitable, short-lived stock with no future. But today, the scenario is very different. Before talking about that, let's break down each business of Zomato first. Wait till the end to know the most promising part of their business. Number 1 is food delivery. There are restaurants, customers, and drivers. Zomato is simply a platform that acts as the middleman to connect these three. But this segment of their business was in losses for a very long time. This business was burning money. It was heavily funded by institutions to keep the ship afloat. Why is that? It takes a significant investment into fixed costs like entire tech teams to create and run the platform. But in Q2 FY23, the company became EBITDA positive. Let's give you a quick explanation of EBITDA before moving on. EBITDA is earnings before interest, tax, depreciation, and amortization. In simple terms, it's the core operating profit of a company before they pay out their interest and their tax. Let me give you an example. Imagine I'm selling pizza. My sell price is 500 and my cost to make and deliver the pizza is 400. In simple terms, I'm making 100 rupees per order. I'm EBITDA positive. This is an oversimplification, but you get the point. The problem with Zomato for a long time was that when they're selling their pizzas for 500, it's costing them 600 rupees. So at a fundamental level, this was a big problem they were working towards solving. But now the scenario is very different. Due to high order volumes, the high fixed costs get subsidized and the company has become not only EBITDA positive but net positive. This is sending the share price of the company soaring. Let's look at some financials. Their GOV, which is the gross order value, has been consistently increasing from 6,425 crores to 7,318 crores in Q1 2024. Their customer base is also rapidly increasing from 16.7 crores in Q1 2023 to 17.5 crores in Q1 2024. As India adopts technology in their day-to-day life, the user base of such platforms increased dramatically, which is another major reason for the uptrend in this business. Their next business arm is Hyperpure. The concept is simple, farm to fork. This arm of Zomato provides all raw materials needed to operate a restaurant. So, if a restaurant wanted to source local vegetables, they can directly buy it from Zomato, who source it from carefully chosen farms. Zomato is taking the Apple ecosystem approach to food. If you have an iPhone, it works seamlessly with your AirPods, wants to connect to your Apple Watch, MacBook Pro, and more. This is the ecosystem effect. This increases the customer stickiness to the brand. If an Apple user wants to switch to Samsung, for example, they not only have to think about switching their phone, they also have to switch their AirPods, their Apple Watch, and more. Zomato is doing the same thing to their restaurant partners and customers by providing solutions to all pain points in the food business, making the brand stickier and taking a long-term approach to business. Hyperpure as a business is still not EBITDA positive, but it's showing promising signs of getting there one day. To achieve this, Zomato has started making key changes in the business model. Number 1, they are removing unprofitable restaurants from the platform. Number 2, they have set high minimum order values to stop restaurants from ordering in small batches, leading to losses for Hyperpure. And number 3, they are heavily investing into working on supply chain efficiencies to decrease back-end costs. These three together will lead to long-term gains in the business value of Hyperpure. Now let's back these strategies with some data. Their revenue jumped from 273 crores to 617 crores in just a year. This is a very high growth rate for such a large business. In the same time frame, their EBITDA has gone from negative 16% to negative 6%. This trend of decreasing losses is owed to the three strategies they implemented. Now, Let's talk about their third and most promising part of their business, their quick commerce platform, Blinkit. You must have heard on the internet how difficult it is for quick commerce businesses to be profitable. Blinkit and Zomato, both giants in the space, are struggling with this exact same problem. It's fundamentally tough to make profit on a business where the consumer behavior is ordering small items frequently. If I want a can of Coke worth 20 rupees, I can pay a small charge and order it from Blinkit. Let's say the whole order costs me 45 rupees. In such a small amount, the company has to process my order, assign a delivery rider, get it picked up from their dark stores and drop it off to my house, all while trying to make a profit. It's inherently a tough business. But counterintuitively, the Blinkit average order value is on the rise, reaching close to that of Zomato's food delivery business. Deepinder Goyal, founder of Zomato, is very optimistic about Blinkit. He mentioned in an interview that it will outperform Zomato in the long run. Now, let's look at their financials. Their gross order value has gone from 1712 crores to 2140 crores. This is 100% year-on-year growth. This shows why Zomato is so optimistic about its future. The company's adjusted EBITDA margin has also gone from negative 27.8% to negative 6.2% in the same time frame. Now, let's talk about the valuation of Zomato as a whole. Overall, the company made 12 crores in profit from all three businesses combined. But the question arises, how do you justify a valuation of 1,67,000 crores of a company that only made 12 crore rupees? Traditionally, the valuation of a company is a multiple of either their revenue or profits. A 3 to 10x of profits is what's fair while valuing a company. Then is Zomato overvalued? You see, we can't use traditional valuation models to value Zomato, a tech-focused D2C brand in India that is investing heavily into its platforms and onboarding users, burning money every quarter, can only be valued by what you think the company will be able to achieve in its future. That's it. It's a pure bet, a risky investment we make when investing in Zomato, hoping they succeed in their vision. Such investments are high alpha. What is high alpha investing? It means your downside risk is high, but your upside, your reward is much greater. For example, with Zomato, it's highly possible that we see a 50% drop. But on the other hand, in a 5-year time span, we could also see a 3x jump. This high alpha investing needs to be done dependent on your risk appetite, investing style, portfolio size, time horizon, and many factors we can't get into in this video. Portfolio making is a very nuanced topic that deserves its own video. So if you want to see such content, comment portfolio down below so I know there is an interest for this topic. Zomato is a good bet in India's upcoming tech-focused brand era. Invest or not, that's your decision, but invest smartly with all available information. Thank you for watching Masala Market. See you in the next one.